Hi there, Internet fans. Ryan Perry here, Simple Biz Support. Today, we're going to talk taxes again with Evelyn Ivy, the CEO of Lifestyle CPA. And we're going to talk about how to keep money in your pocket and how to protect yourself when it comes to taxes and the IRS. So, Evelyn, welcome to the show again. I appreciate you taking time out of your very busy schedule to talk taxes and helping business owners really not only be prepared, but understand what they need to understand in order to protect themselves and keep as much money in their pockets as possible.
Thank you for having me.
Yeah, definitely. And today I understand we are going to talk about tax, not tax structure, but corporate structure as it affects taxes.
Yeah, especially as it concerns with a new business tax deduction called QBI, also called the Qualified Business Deduction. So
Okay.
that's something new for,
I was going to say, and this is something that is new to 2018, correct?
that's correct, yes.
Okay. And before we go into the details of it, are there like any misunderstandings, or is it's something I've never heard of until we initially started talking about it? Are many business owners, do you get the sense that they're even aware of what this is?
Well, it has been on the news and on the newspaper, so if you've been reading, at least you have seen something about it. Maybe you
Mhm.
didn't quite understand what it was, but at least you know there's some kind of change coming.
Okay. The business people that you're talking to, there is some understanding, but they don't necessarily know what it is.
Exactly.
Okay. So can you give us a brief explanation of what it is first before we actually talk about how it's going to affect taxes as it relates to your business structure?
Okay, yeah, sure. So this was actually an effort for Trump to bring businesses back to the United States. So to do that, what he did was try to lower corporate taxes to 21%. And then the question came about, well, most small businesses are not corporations. They might be CS Corps, they might be sole proprietors, what about them?
Hmm.
So they thought about it, and this is what they came up with, the qualified business income deduction. So in other words, just because you're not a corporation, you can still get the benefits, just like a corporation is getting for the lower taxes for business owners. So that way, that can, even though it was initially to bring businesses back to the States, but it's also going to spur economic activities.
Okay. And so you're saying that corporations got a tax break, dropping it down to 21%, I believe you
That's
said.
correct. Hmm.
And then that this is designed for non-corporations. So does that
That's
mean I
right.
have to be a sole prop or an LLC?
You have to have a qualified business. Yes.
Okay, so
Doesn't, yeah.
how do we verify, or how do we determine what a qualified business is?
Well, a qualified business, I mean, you're in the business of in trade and business to make money. So you're not a hobby. You're not, you have your full-time job, then you sell a couple of things at night. You're a real business in the business of making money.
Okay.
Now, there are other things I'll go into, like it's split into general businesses and specified service business. So if you're a service, you have one sort of rules, and if you like a general business, like a product business, you have another set of rules.
Okay, and are we going to be covering both of those companies today, service and product?
As time, let's see what time allows, but I do,
Okay.
if the questions, yeah, yeah.
Okay, fair enough. So where would you like to start with this?
Well, let me start with what the qualified business income is and what it's not, and what you can expect.
Okay.
Is that okay? Okay.
Yeah.
So the qualified income is the net amount of the business income. It includes income gain, so in other words, it's your income less any deductions, plus any gains less your losses. So in other words, in most cases, it will be your net income, because a lot of businesses, like small businesses, don't have a lot of advanced structures. It's just really easy. You have your income, expenses. So your net income is your
Hmm.
qualified business income. So you do get 20% of that as a deduction. But however, it's limited by your taxable income. So your taxable income, okay,
Okay. I was just clarifying, are we talking about the company's taxable income or your personal taxable?
personal, because yeah, it's a pass through. So it passes through to your personal. So
Okay.
your taxable income, obviously on your personal, you have other deductions. So you're not taxing 100% of your business income. So all those deductions will actually make your qualified business income deduction less.
Hmm.
So in other words, your taxable income is not necessarily your business income, because on your personal side, you do have other deductions, like a standard deduction, itemized deduction, if you put money in a retirement account. So all of those things will actually affect your qualified business income, because they'll affect your taxable income. So you take the lesser of the two. Now, if your income, if you're single, if you're married, and your qualified business income is less than 315,000, you're okay. No special rules apply to you. You're just fine. And if you're single, head of household, any other filing status, it's 157,500. So depending on, you know, your filing status and how much money you make, then we go into those complex rules.
Okay, so to keep things easy, you're saying if you're single, head of household, it's 157,500.
That's correct, yes.
If you're married, it's
315,000.
315,000. So if that is good, then are you saying that you do qualify then at that point?
You do qualify. You don't. So you qualify with no special rules. You just take the deduction.
Okay.
But if you make above that amount, then you have special rules that apply to you. And there's something I should mention.
I was just wondering, for those that are watching the video, then if you're under those income thresholds, this is very relevant to you. If you're above those thresholds, it seems like you would definitely want to have a deeper conversation with your CPA at that time.
Yes.
Okay.
And I can touch about some of the special rules too, so you can see how it affects you. I mean,
okay, perfect.
There's something else I should mention about if you're S corporation, you do have to pay yourself reasonable wages. So don't think like, oh, I'm going to get as much QBI as possible and not pay myself wages. Like, no, that the IRS, they know people are going to try and do that, and they've already instituted fraud. Like, they're going to penalize you even more than they'll penalize you if you did something like that.
And is that something that if you try and look, I would consider that kind of like double dipping then, if you will? Is that something you believe is something, if you push the limits on that, you might be flagged then by the IRS for an audit?
That's right, yes.
Okay. That's always good to know, because the IRS isn't necessarily looking at everything as far as which businesses they want to flag. My understanding is every year they kind of have certain areas that they're focused on, and businesses that show up in those danger zones in those specific areas are the ones that are more likely to be flagged than, say, the year before where they weren't looking in that area.
That's true. Yes.
Okay.
Correct.
All right. So good to know. So make sure you're reporting your wages honestly. And if you qualify, what happens then if you do qualify?
Well, you do get the business deduction. So this is the time I can actually show you an example of what that is. So if you don't mind, I would like to share my screen.
Yeah.
All right. So let's say you make 85,000. You paid yourself 25,000 your business. So that's your net income. So 85,000 is after you're taking out all your expenses, and then you paid yourself 25,000. And so just to say, if you're a sole proprietor, so I did for sole proprietor, partnership, corporation, and S corporation, just to show you what the qualified business income is and how it can affect your tax, excuse me, your taxes. So here you see all of them all have a net income of 85,000.
Right.
Well, the sole proprietor is not going to pay themselves any wages because they don't have to, and also partners don't have to pay themselves wages, but the S corporation and the corporations have to. So the business taxable income in this case is, for the sole proprietor will be 85,000. For the corporation and S corporation, there'll be adjustments for wages. So in other words, their business income will be 57,000 for the corporation and S corporation after payroll, because they paid themselves 25,000. Make sense so far? All right. So this is let's say this is a person. Let's make this a single person, and then so we see the business income, and then here in green, let me make that a little bit bigger. I feel like it's small. That's the qualified business income. It's 20%. In this case, is limited to 20% of taxable income. So we can see that the QBI as a sole proprietor is 13,393, As a partnership, it's the same thing because sole proprietors and partnerships get taxed the same way.
Okay.
And then as a corporation, you get nothing because you have the lower tax rate. And then as an S Corp, your qualified business income is $11,533. So it looks like the S Corp has the lower qualified business income deduction, but here's the thing. By the time you figure out self-employment taxes for both the sole proprietor and partnerships, you can see how much lower the taxes is, including all the payroll taxes, is for the S Corp when compared to other filing structures. So you can see the sole proprietors paying and partnerships are paying $19K, almost $20K. The C Corp with the lower tax rate pays $15K, and that includes all taxes, includes payroll taxes, includes business taxes, includes every tax you're paying. And then the S Corp pays $11,281, even when you consider the payroll taxes. So without the qualified business income, this business owner would have paid taxes on, so we see the taxable income is $17,667. That's how much they pay taxes on. But with the qualified business income, they get that deduction, so only get paid taxes on $59,134.
Okay, interesting. So this is effective 2018. This isn't something that we could have done last year.
No, it's 2018, yes.
Okay. And so at this point, it looks like, at least from this analogy, the spreadsheet that you've put together, that being an S Corp is an ideal way of making sure that you get as much tax benefit as possible. Here it is, we're in October.
If you're if you make under 157,500 single, but if you're in the high, if your personal tax rate is above 21%, corporates, now I have an example of how the corporate structure will be better for you in that case.
Okay, but what I'm curious to know is that if I'm a sole prop at this point, am I in a position where I could go, hey, let me talk to my CPA or give you a call, and can I then talk about becoming a corporation for 2018, or is it past that point and this is something I need to focus on 2019?
You can still do technically it's late, but the IRS does allow you to do a late election. So you can have a late election for 2018.
Okay. So if
but you have to have an excuse, yeah, for why you're late.
QBI. I didn't know about this QBI thing. I don't know if that would roll with the IRS, but hey, we could give it a try.
I mean, normally they're very lenient when it comes to, they're like, oh yeah, whatever. They accept most excuses.
Okay. And then you said you had another example, and this other example is if you have a higher income?
Yes, if you do have a higher income, which the free version of this does not compute, but using the paid version of it, you can see if you have a higher income.
Right, and just to clarify, when you say a free and a paid version, you're referring to this Excel spreadsheet, correct?
Yes, so the paid version computes the taxes for more, like it computes credits, everything, like total tax picture versus just a scenario right there.
So I want to make sure the viewers understand that they can actually use the same exact Excel file and run their own scenario to see how they are affected with QBI and some other tax situations for them. And there's a link below in order to find out more about this Excel spreadsheet. Okay.
So the higher income level, this person is making $250,000. They pay themselves $50,000. As an S Corp, they'll pay $80,289 in taxes. And as a C Corp, they pay $56,869 in taxes. So you can see at the higher level how it makes sense if you're a C corporation.
Right.
So even though you do have the QBI deduction, at higher levels, you do have the limitations, which you really can't take that deduction. And so because of that, the C Corp structure might actually be best for you.
Correct. And the structures are set up in a way that they're designed to work at different levels of business. So as you're starting out, maybe a sole proprietorship is the way to start out based on your expected revenue. Then as the business advances, you can bump up into an S Corp. And then as things grow into a C Corp, because there's other benefits besides tax benefits as to how you actually set up your business.
That's true. That's true. And there's liability, protection. And like I always say, like when people try to open their business, say like, what's the structure? What's that? I'm like, how are you going to make money?
Right.
Because people spend so much money in developing the structure, having everything all together, and it's like, all right, my doors are open, and it's like, okay, oh, there's no money. There's no money. There's nothing to protect. What do you
Right.
protect? So you protect assets, but there's nothing in there. So I say, first of all, prove your concept, and
Right.
then start going into all of that details of, okay, now here I do have something I need to protect. How do I best do it?
Yeah, and that's another great reason why you should be speaking with your CPA on an annual basis
Mm-hmm.
to kind of talk through, like we talked about in the last video. If you're an S Corp, C Corp, making sure you're having those annual minutes taken. But additionally, it's really about planning not only for taxes, but really understanding the numbers in your business. Where are you going, and where do you need to shift in your business in order to get where you want to go?
That's right. Yes.
All right, very good. So with this shared screen, is there anything else that you want to
Yes.
share in this video?
Yes. So this is a situation where a business owner is making $250,000. So their service business. So
Okay.
with a service business like a CPA, a business where the owner controls, like a lot of the income comes from the owner. So like someone like me and you,
Right.
um, we're
Your
called specified.
attorney, your optometrist, your dentist, where they're the only one.
Mhm. Yeah. So even if they have employees, but we still make most of the money,
Right.
without. So there's special rules for you. And what happens is if you make above the threshold of 157,500 single
Hmm.
and 315,000 married, so it might just be, even when I say 315, that includes your spouse's income.
Okay.
So what happens is there are limitations based on, over. So if you make over that amount, like what happens is, unless you pay yourself wages or you have assets, you don't get the QBI. So you're subject to wage limitations and how much assets you have in the business.
Okay.
So here's an example, and then if you make over $415,000 if married, then you don't even get it at all. But here's an example with that. So this is a person making $250,000, and then they have 50,000. They have here I put an example of where they pay themselves no wages, and they actually pay themselves wages. So
Hmm.
we can go down and see what the QBI is. So you can see here they have no QBI. Oops, my bad. I clicked. I wasn't supposed to click. Okay. And then here you can see, because of the wage limitation, they get a QBI of 25,000. And then we can see the difference here is, they save 10,234 in taxes just by paying themselves 50,000 in wages when you're that high.
Okay. So with this Excel spreadsheet, you could also kind of play with how much is a good wage to pay yourself, because you're taking into account for payroll taxes also.
Not the free, yeah, with the paid version you can.
Okay.
We didn't talk about that, but the free version is just a very simple calculations for lower income levels.
Okay, perfect. And the
But
idea
yeah,
here
with the
is to,
paid, yeah.
yeah, and the idea, and let me know if I'm wrong, but the idea with this calculator is to give you a general idea, general understanding of what could happen, so that you
Mm-hmm.
have some knowledge. And I think that's really important, because when you come to a CPA, you do need to understand your numbers.
That's
And
true.
so having that additional knowledge is going to be very powerful for you, I would imagine, as a business owner. At least I would find it powerful.
That's right. And let me say something about meeting with your CPA. The more you know, the more effective a meeting is. People think like, oh, I'm going to my CPA, I'm just going to trust them everything. But the truth is they can only help you with as much information as they have. And if they don't have as much information, you have to understand you're not their only clients. As much as they'll love to help you, and they have other things to do. And so if you come with less knowledge and less information, you don't get as good a service as someone who is actually on top of things, on top of their numbers, know the questions they need to ask, then they can get more help. So it's actually a good thing to prep yourself before talking to your CPA, so you can
Right.
make the most of both of your time.
All right, perfect. And then since you still have the screen up, is there another sheet in here that you want to show us?
Yeah, so let me look at, we're looking at a business with property. So this business has like $1 million in property. So we can see they'll even further save because, you know, when you have a lot of assets, that's another way to prop up your QBI at higher wages.
So
So,
you're saying a business with a lot of assets can,
mhm.
the QBI could be a benefit for them?
Yes, maybe they have property, they have like, a lot of, equipment, things, that could actually help them, at very high income levels.
Okay.
So here, let me just talk about this here. So here you can see that the business income and then when I was talking about business income, taxable income. So you can see the QBI income in this example was 85,000, but a taxable income was 66,994.
Mm-hmm.
So, so the difference between, I said earlier, difference between QBI and taxable income is in the taxable income, you do have other deductions that you arrive at. So even though you might have 85,000, doesn't mean you're going to get 20% of 85,000. You get the lesser of the two.
The lesser of the two.
Mm-hmm.
Okay, that's good to know.
All right.
All right. So it sounds like
So
the IRS has done a wonderful job of convoluting what is already a convoluted process of filing for taxes.
that's right. Yes, they've put a lot of work. I mean, especially with the short notice they had. So they've put a lot of work on this and trying to trying
Right.
to
Yeah,
give
and
you
I'm
the
just
tax rates.
thinking like TurboTax, trying to figure all this stuff out through TurboTax. I would imagine it would be a nightmare. So being able to talk to somebody who's actually
I will,
studied it and understanding it
yeah.
would be very, very beneficial for you as a business owner.
If you're a business owner this year, I will not recommend you do your own taxes because the risks are really high. You do something wrong,
Hmm.
you're going to be penalized. So you might be like, because TurboTax will like, because I can put my numbers and do my own taxes. And sometimes when I get those tax returns from TurboTax, people will take ridiculous expenses out. Like, oh, I did this. I'm like, it's not a business expense. Like, no. So, but yeah. So we have to be. I will say, if you are a single person and all you have is just a W-2, by all means go for TurboTax because without the itemized, with the higher standard deduction, filing your taxes will be so much easier. But as a business owner, with all the
Right.
tax changes this year, please do not even try and do it yourself. Talk to a professional.
Yeah. Yeah. Wonderful. And that could be somebody local or somebody remotely, such as Evelyn. Being a CPA, she's always looking for new business, happy business owners who really want to understand their business and move forward. And it's a working relationship. I mean, working with the CPA really should be a working relationship, I
Yes.
feel.
Yes,
So,
it
all
is.
right, wonderful. For people that are interested in learning more about the Excel file, there is a link below. In fact, down below here, you should actually see that link. Plus, there'll be a clickable link that'll take you right there so you can learn more about that Excel spreadsheet. Punch in your numbers for free. If you want to get the advanced version, you'll be able to figure out how to purchase that advanced version also. With that being said, is there anything else we need to cover as far as QBI?
The main thing is, let me just summarize what I've said so far. So the QBI, 20% deduction,
Mhm.
based on your business structure, it does affect that. You do need to pay yourself wages if you're S corp. It's limited. It's limited based on higher income levels. So if you make above 157,500 and 315,000 if you're married,
Mhm.
then you have limitations. And then the other thing is, if you're a general business, what happens is there are no limitations, but you do have thresholds. So in other words, you're phased out. Um, you're phased out, with higher income, but you still get some of it. But if you're like a service business, if you make over the 415,000, you're completely, and you're married, you completely don't get the deduction.
Okay, so the QBI deduction, it sounds like, is really going to benefit those that are on the lower income side of their business.
And if you're on the higher income side, it will benefit you too. If you just make sure, like with the wages and everything, that helps. If you pay yourself the right amount of wages, then you can increase the QBI too.
Right. So it's really a
So,
matter of playing that
mhm,
IRS game of where do you put the numbers so that you get the best
exactly.
results in the end.
That's right.
All right. Wonderful. All right, Evelyn, I appreciate your time. And for those that are looking for more information on QBI, make sure you check out the link below.
All right. Thank you.
All right. Thank you. With that, thank you very much. That's the end of this video. Take care.